Shares of major Chinese tech companies soar and Apple revenues rise 9% to $97.3 billion. You're watching the Daily Brief with Forbes. I'm Ramia Farrage. Shares of major Chinese tech companies soared today after a meeting in which top officials called for the healthy development of the sector. It fueled hope among investors that a damaging state crackdown may ease. Beijing has embarked on a sweeping clampdown over the past year that has clipped the wings of its biggest internet firms. Shares of Chinese tech firms rocketed in Hong Kong, with JD.com and Alibaba rising around 15%, while Tencent shares jumped 11%. And that surge had a big impact on today's Forbes Real-Time Billionaires ranking, where our third highest gainer today was Tencent's Ma Huateng, up $3.9 billion with net wealth of $39.9 billion. Our biggest winner today, though, is Mark Zuckerberg, up $10.7 billion with net wealth of $73.6 billion. And our second biggest winner today is Jeff Bezos, up $6.4 billion with net wealth of $170.4 billion. And staying with Bezos, shares of his e-commerce giant Amazon rose 4.7% in after-hours trade overnight, despite delivering disappointing quarterly results and outlook. Amazon blamed overcapacity, inflation, and supply chain challenges as the company reported a $3.8 billion net loss for the first quarter, compared with $8.1 billion profit for the same period last year. Amazon says the loss was due to a $7.6 billion decline in the value of its stake in electric vehicle firm Rivian. Apple's quarterly revenue rose 9% to $97.3 billion, driven by strong demand for iPhones and digital services. However, the tech giant projected a dent in sales revenue to the tune of $8 billion in the next quarter due to COVID-related restrictions in China and ongoing supply chain challenges. The iPhone maker's gloomy outlook sent its shares tumbling nearly 6.2% to close at $163.64. iPhone sales, its biggest source of revenue, increased 5.5% to $50.6 billion in the quarter. Shares of stock trading app Robinhood tanked roughly 8% last night after the company reported dismal Q1 earnings, which showed that the platform lost over 1 million users and revenue plummeted 43% from what it was a year ago. Robinhood's quarterly revenue fell to $299 million, a sharp 43% drop compared to $522 million in 2021. Transaction-based revenues plunged nearly 50% from the same period last year amid a marked slowdown in options, crypto, and stock trading from users on its platform. Tesla chief Elon Musk sold about $4 billion worth of shares in the EV maker in the days after Twitter's board agreed to his $44 billion takeover. Musk sold 4.4 million Tesla shares, leaving him with 168 million shares in the car maker via a trust. Musk has pledged up to $21 billion from his personal fortune to finance his Twitter takeover, with the rest financed by debt. Twitter stock closed at $49.11 a share Thursday night, much lower than Musk's offer of $54.20 a share. In other news, Eurozone inflation inched up to a new record high as expected this month, rising to 7.5% in April from 7.4% in March, driven by a persistent surge in energy and food prices. Eurostat data shows that although volatile energy costs were the biggest contributor, the rate of energy inflation actually declined compared to March. Meanwhile, there was price growth in food, services, and non-energy industrial goods, suggesting that inflation is becoming increasingly broad-based. And finally, Tom Cruise has unveiled his world-first screening of Top Gun: Maverick in Las Vegas, introducing the long-awaited sequel while balanced atop a flying biplane. The new Top Gun, which picks up the story of Maverick and his fighter pilot buddies 30 years after the blockbuster original, was scheduled to open in 2020 but was repeatedly delayed by the COVID-19 pandemic. Cruise, famous for doing many of his own stunts, introduced the screening with a video message recorded in typically hair-raising style, perched on the moving plane's fuselage from the skies above South Africa. I'm Ramia Farrage. This is the Daily Brief. Thanks for watching. Bye for now.